Now, that can sound similar to what we were just looking at.
Oh.
But what structure is all about is understanding positioning. And where your edge comes from here is your market selection. Too many people are too rigid on market selection. They are very clear that they trade the S&P, they trade euro dollar, they trade oil, and they don't trade anything else. But understanding positioning, understanding how recent action has created that positioning, enables you to better select markets for certain situations. That gives you a huge amount of edge, because now you're playing a market that, rather than you looking at it and thinking, well, I always trade this, let's hope it works, you're now trading a market that you can say, if this starts to move in a certain direction, I have good scope here. So it means that once the market starts to move, you're going down the path of least resistance. Anybody who traded the S&P yesterday on the Fed will have found that a very, very tricky move. It did not maintain any consistent direction. We traded up, we traded back, we traded lower, we traded higher, and then we traded lower again. Trying to define a clear-cut direction on the S&P yesterday was virtually impossible. Yes, there were short-term moves, but if you'd selected a market based on positioning, based on looking at the structure, you didn't need to be trading the S&P. And there were some much, much cleaner moves. And anybody who's on the Telegram group, if you signed up, you can get onto that Telegram group. Anyone who's on the Telegram group yesterday will have seen my reference to gold and the euro. These were the two that offered the greatest potential based on structure. And in particular, gold, because gold gave you a two-way opportunity. So you can gain a lot of edge by your market selection. We saw this with a lot of traders yesterday. Far more people traded gold on the Fed yesterday than we have seen in recent months, simply because the scope of gold was there, because the structure set you up. Now, I'm sure a few people are thinking, well, how do you determine positioning? Is this to do with open interest? You know, how do you determine what positioning is all about? Oh, well, thanks. Thanks, Maria. There we go. We helped on the S&P. The S&P was there. The S&P was there for some moves, but they were intraday. There was not a point with the S&P where you could have said, yep, it's clear it has got open space that way or that way. The S&P had space, but they were very much moves you could take one way, then take the other, then take the other. It was a day trader's market. But where the greatest edge and opportunity came, the clearest edge, and this is the point, the clearest paths are the ones that you can leverage up the most. I do agree with that, KS, that you can look at it like that, but being able to expand your horizon means that you are now able to select markets to perhaps offer you more. And this is what I'm trying to get at with how do you improve edge. Yes, you can trade what you're comfortable with, and you can gain edge there by leveraging up in those markets because you're more comfortable. But if you've got something that you can kind of say, well, once we pass that point, this isn't coming back, then even if it's not your main market, you can be very, very comfortable and convicted on that trade because there is so little to say that the trade's going to go wrong. That's what edge is all about. It's about looking at a market, and the market basically says to you, you've got to do this because this almost can't go wrong for you. Of course, trades can go wrong. I'm not saying that you can get a perfect trade. But what I am saying is you can get yourself into a situation where there's so few things that are going to go wrong. That's where the edge comes from. That's where the opportunity really lies. Now, positioning is always a tricky thing to try and understand. And what you can't do is you can't absolutely know what people's positioning is. But what you can do, and this is how I go about doing it, you can go about thinking about how people are going to be positioned based on what's happened. Put yourself in the shoes of somebody who's a little bit more long-term. What are they thinking? What's going on for them? So we'll go and dig into this, and we'll look at gold in particular. The euro, what the euro had got over the past 3 days is a very, very steady trend. Now, with markets with very steady trends, one of two things will come. Either people selling, so sort of limiting the trend up, eventually get forced out. And particularly as this was at the top of a 2-month-old range, that gave the potential breakout. The alternative for euro is because of the way that this moves up, this suggests that the positioning is people increasingly getting long at higher and higher prices. That's what I call vulnerable positions. If I've got vulnerable positions, I also have an expectation of an easy turnover if the market starts to drop. So it doesn't mean that I know what's going to happen, but it means that I know the nature of what's going to happen. And that's where the edge is from structure. So let's go and have a look at particularly gold as to what went on. Now, what I've got here on the left, we've got profile. On the right, we've got an hourly chart from the previous week with the volume profile of that entire week and then the beginning of the current week. To join Telegram channel, if you click on the link that I posted a little moment ago, and I'll repost it for you. Link there. If you sign up, you can see the previous videos. You can also join our Telegram channel as well. I generally try and keep people abreast of what is going on there, and equally you can search Axia in the Telegram app. Make sure it is us and not anybody else spouting stuff and impersonating us, though. Right, get in there. Okay, so how to understand positioning. What you've got to think about is what's happened recently. Now, the move higher in gold is a relatively simple one to understand. This is a risk off move. People want safety, people buy gold. So gold rallies. Once it appears that the SVB situation has been minimized and potentially now solved, the gold starts to fall back. So what you've now got is some of that risk is getting priced out. So now we're into a situation where we've got two potential outcomes. You're at a decision point, and this is what I felt gold from a structure perspective gave you so much on the Fed. Where you are is inside this area of low volume. That is the area with no value on your profile here or here. Basically from sort of 1950, 1948 down to 1938, 1936 area. So what you've got to think about is think about positioning. You've got a load of people who are long up here. Now, not all of them will have been forced out on this move. Some of them still think there may well be a risk out there. They're still going to hold on to their longs. If, however, you break the box to the downside, now you've got a load of longs who, again, are going to get forced out, at least the people who are long in here. So that then tells you that, yes, there is scope for downside here. And you can understand how that's going to come about because you've got a load of people who are probably still long who are going to get pushed out. Equally, though, on the back of the recent move, you will have a lot of new shorts. Think of day traders, short-term people who have looked at this drop, seen this balancing, gone, yes, flag, continuation down. So you can see from either perspective how you've got people trapped in that area. If you've got that, you've now got people trapped in. This is the structure. This is the positioning you're interested in. Because now it means going into the Fed, and this is what made gold so good. It didn't matter which direction it went. Gold had good scope for liquidation. And that's why gold was the one that many people looked for on the Fed yesterday. Yes, typically people do go for the S&P, and yes, I can understand the arguments for bonds. But bonds were still in a situation where they had the potential to continue towards the downside. Bonds look weaker than gold. So I had to do some work to get up. The S&P had already completely reversed the equivalent of this move. So the S&P for a continuation to the upside was more limited in its scope. So what you're trying to do is you're trying to select a market based on what the potential is, what it can give you. And that's why gold then becomes one. It's about that understanding structure. And structure is what then gives you edge. So what you get on the decision, and I'll show you this in just a moment, is you get this positioning unwind. This is a huge value opportunity because once it starts to happen, you know that there's easy scope. Once you get up above 48, there is an easy move up towards 69. So it means you're going to get a move that is relatively clean. It is relatively quick. Once you're on it, there is nothing to get in your way. And there is everything to help you on your way. All of the people short down here are now wrong. They're trapped. They're going to get forced out of this trade. So that's the key bit to understanding position. That's how positioning gives you edge.